But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
So, and I said, well, what if it does happen? And he says, well, price will solve everything. I said, thanks, give me the gold.
Why do central banks hold it? Well, it's a form of reserves. So why don't they hold diamonds? Well, it's tradition, long-term tradition.
Well, some people still think it's money.
Good afternoon, everyone. Welcome to the most boring channel on YouTube, aka the Junius Maltby channel. Today it is just myself, Mrs. Maltby, as Junius is away. Now, I found an article here I thought was interesting enough to share with you all, and perhaps this is repeat information for most of you, but the good thing about this channel is we're open to discussion and debate in both the live chats and in the comments below the video. So keep in mind, anything we report, it doesn't necessarily mean that we agree or we hold the same opinion, and that's where you all come in. But this article is titled, "The 3 Most Repeated Falsehoods About Gold and the Forceful Responses of Jim Rickards." Gold is in the early stages of its 3rd big career that will take it to record highs. The first 2 big bull markets were between 1971 to 1980, where gold rose 2,200%, and 1999 to 2011, gold rose 760%. After peaking in 2011, gold fell sharply from that peak to less than $1,100 per ounce in 2015. According to an analysis by economist and investment banker Jim Rickards, the 3rd major bull market is now underway, which began on December 16, 2015, when gold bottomed at $1,050 per ounce at the end of the 2011 to 2015 bear market. Since then, gold has risen significantly, but it is a small change compared to the gains of 2,200% and 760% in the last 2 bull markets. Still, most traditional economists dismiss gold. They call it a, quote, barbarian relic and say it has no place in the current monetary system. Rickards recalls in an article published in The Daily Reckoning that the 3 main arguments that mainstream economists make against gold and why they are completely wrong, as outlined below. The first of these 3 arguments that you may have heard many times is that experts, quote, say that there is not enough gold to sustain a global financial system. Gold cannot support all the paper money in the world, its assets and liabilities, its expanded balance sheets of all the world's banks and financial institutions. They say that there is not enough gold to maintain that money supply. Well, that argument is complete nonsense. It is true that there is a limited amount of gold, but what is more important is that there is always enough gold to support the financial system. The key is to set your price correctly, says the writer. It is true that at the current price of around $1,875 an ounce, if linked to the existing money supply, it would be highly deflationary. But to avoid that, all we have to do is increase the price of gold. In other words, take the existing amount of gold, put it at, say, $14,000 an ounce, and there will be plenty of gold to support the money supply. In other words, a certain amount of gold can always support any amount of money supply if its price is set correctly. There may be a debate about the proper price of gold, but there is no question that we have enough gold to support the monetary system. Just take the amount of money supply in the world, the amount of physical gold in the world, divide one by the other, and there is the price of gold. Governments are desperate to overcome disinflation and deflation. The excessive debt burdens are an obstacle to growth and lead to precautionary savings, which are deflationary. The only reliable way to end deflation, and no, money printing doesn't work, is to devalue the dollar against gold. This was done in 1933 and 1971, and it worked to create inflation both times. An 85% devaluation of the dollar, roughly the devaluation achieved in the 1970s, will inflate the debt burden, stimulate nominal growth, and result in a gold price of $15,000 an ounce, says Rickards. But again, it is important to realize that there's always enough gold to meet the needs of the financial system. Again, you just need to get the right price. Regardless, my research has led me to a conclusion. We will see the collapse of the international monetary system. When I say that, I specifically mean a collapse in confidence in paper money around the world. It is not just the death of the dollar or the disappearance of the euro. It is a collapse of the confidence of all paper currencies, he continues. When confidence is lost, central banks may have to go back to gold as a benchmark or a real gold standard to restore confidence. That would not be by choice. No central banker would voluntarily choose to return to the gold standard. But in a scenario where there is a total loss of confidence, they will probably have to go back to some form of the gold standard. If you are going to have a gold standard or even use gold as a benchmark for money, if you need to restore confidence in the dollar, the non-deflationary implied price is $15,000 an ounce. The second argument raised against gold is that it cannot support the growth of world trade because it is not growing fast enough. World mining production is about 1.6% of total gold stocks. World gold production has actually stagnated at around 3,300 metric tons over the past 5 years. Global growth, excluding 2020 due to COVID-19, is approximately 3% to 4% annually. Critics say that if global growth is around 3% to 4% annually, and gold is only growing at 1.6%, then gold is not growing fast enough to support world trade. Therefore, a gold standard gives the system a deflationary bias. But that is also nonsense, because mining production has nothing to do with the ability of central banks to expand the supply of gold. The reason is that official gold, the gold owned by central banks and finance ministries, is around 35,000 tons. The total gold, including gold privately owned, is about 180,000 tons. That's 145,000 tons of private gold outside the official gold supply. Hello, ANCAT. You want to come up here? All right. If any central bank wants to expand the money supply, all it has to do is print money and buy some of the private gold. Central banks are not constrained by mining production. They don't have to wait for miners to extract gold if they want to expand the money supply. They simply have to buy some private gold through dealers in the market. Arguing that gold supplies are not growing enough to support trade is an argument that rings true on a superficial level. But when you look at it further, you realize that it is silly. This is because the supply of gold added by mining is irrelevant, as central banks can only buy private gold. The third argument you hear is that gold has no performance. That is Warren Buffett's main criticism of gold, even though he has now invested in precious metal stocks, as well as that of Dave Ramsey. And if you haven't, go check out the videos that Junius has done on that individual. True, but gold is not supposed to perform. Gold is money, and money offers no return. Once I was at Fox Business with Maria Bartimoro. We had a discussion in the live interview when the topic came up. I said, Maria, take out a dollar bill, hold it in front of you and look at it. Does it have a performance? No, of course it does not pay. Money does not pay, says the American economist. If you want performance, you have to take risks. You can put your money in the bank and get a little return, maybe 0.5%, probably not even that. But it is no longer money. When you put it in the bank, it is not money. It is a bank deposit. That is an unsecured liability in an occasionally insolvent commercial bank. You can also buy stocks, bonds, real estate, and many other things with your money, but when you do, it is no longer money. It is some other asset and involves varying degrees of risk. The point is simply that if you want performance, you must take risks. Physical gold does not offer an official return, but it does not carry any risk. It is simply a way to preserve wealth. Gold is money. Therefore, the top 3 criticisms of gold do not hold up once you analyze them correctly. Now, the third major gold bull market is underway, as forecast that gold will reach $15,000 in 2026. Again, this is an article that I'm reading, and I'm sure Junius can include his input on this at another time. Of course, nothing goes in a straight line, and there will be setbacks along the way, but the trend is up, he says. I think the main way every investor should play with rising gold is to own the physical metal directly. In fact, I always say that at least 10% of your investment portfolio should be dedicated to physical gold bars and investment currencies mainly. Ends the analysis of Jim Rickards. And now for many of you, this information is certainly not new. If you've been following the channel for years, you'll know that Junius has done a variety, probably hundreds of videos at this point, talking about what this article mentions. And of course, you may always go back and take a peek and re-listen to those. And for those who are new to this channel, delve into the comments section. Take a look at what some of our supporters, our friends, and our followers for years have to say. Take a look at their input. Gold pill yourself. Educate yourself. Understand that the world is unstable and things are heading in a direction that there is no return from. This train has left the station and it will not return to the destination that it left from. And at this point, we have to learn to deal with the new scenery, the new stops, and the new problems that we will experience along the way. Now, I was going to do an article on silver. However, the more I read down the article, the more annoyed I got because it was too political and too slanted, and that's a problem for me in either direction that it goes, whether it goes too left or it goes too right or it goes to whatever. But the gist of it was that the projected price of silver per ounce should be reaching $50 an ounce. And Junius can address that and revisit that tomorrow, as well as aspects of this video with you all. I am quite ill today, as I mentioned, so I'll be stepping off of here and possibly sleeping the day away with ANCAT. Now, just a reminder, if you have not subscribed to the backup channel, I'd go ahead and do so if you would like to have a safety net if something ever occurred to this channel. It would be my channel in which Junius would continue to post on while he petitioned to get the channel back from YouTube, if it ever was to happen. And the videos that are on there currently are meant to be placeholders, but in the meantime, they give you a more intimate look at our life behind the screen, and they definitely won't be there forever, especially if his channel switches over to that channel for whatever reason, if he's shut down in the future. But thanks for all your kind words about the videos. Some of the things you've said are quite funny. I guess many of you did not expect Junius to look the way he does. And I try to put myself in your shoes, but since I've always known Junius face to face, it's kind of hard to imagine what I would anticipate or what I would think his voice versus how he would look like actually is. So that was funny to me, but have a good day, everyone. Be safe.